Welcome to Corporate Finance Explained, where we break down the essential topics every corporate finance professional needs to know. This series is narrated by AI, created using CFI's expert training materials, and designed to help you stay ahead in the world of finance. Enjoy this week's deep dive.
Welcome, curious minds. Today, we're doing a deep dive into something you hear about all the time, stock buybacks.
Right. They're constantly in the news.
Exactly. Companies buying back their own shares. But what does that actually mean, on a practical level? And why do they do it? Is it smart? Is it controversial?
It's definitely one of the most debated topics in corporate finance.
Yeah.
You hear everything from smart capital allocation to, well, much harsher terms.
Yeah.
So our mission today is really to pull back the curtain. We'll unpack how they work, why companies choose them maybe instead of dividends, look at the good, and definitely look at when they go wrong. We've got some real examples.
And we've got some great source material guiding us, like share buyback strategies and stock buybacks, mechanics, value, and risk. We want to give you that sort of aha moment, cut through the noise so you're genuinely informed.
Sounds good.
Okay, let's unpack this.
Let's do it.
So let's start really basic. When a company announces a stock buyback, what's actually happening, like on the ground?
Okay, so at its core, it's pretty simple. The company goes into the open market and buys its own shares, just like any other investor could.
Okay.
Think of the company as a pie, right? Cut into slices the shares. A buyback means the company removes some slices from circulation.
Fewer slices.
Exactly. Fewer shares outstanding. And assuming the pie's value stays the same or grows, each remaining slice, each share, becomes potentially more valuable.
Okay, so fewer shares outstanding.
Right.
How does it directly help, say, an investor? What's the immediate impact?
Well, the big one is earnings per share, or EPS. That's a metric everyone watches.
Right.
If you divide the company's total profit by fewer shares, the profit per share automatically goes up, mathematically.
Makes sense.
And that often gives the stock price a bit of a short-term kick. It can also, impact executive pay if bonuses are tied to EPS.
Ah, okay. And how do they pay for this? Where does the money come from?
Usually one of three ways. They might use excess cash they have sitting around.
Okay.
They might take on new debt to fund it, or, some combination of both cash and debt.
Right. But you mentioned something crucial earlier, opportunity cost. Using cash for buybacks means that cash isn't used for other things, right?
That is the fundamental question. Absolutely. Every dollar spent on a buyback is a dollar that could have gone into R&D, paying down debt, making an acquisition, expanding the business.
Or even dividends, which is another way to return cash.
Or increasing dividends, exactly.
Yeah.
So the real debate always comes down to, was buying back stock the best use of that capital for the company's long-term health? That's the crux of it.
Yeah, that makes perfect sense. And it leads right into that comparison, buybacks versus dividends. Companies often have to choose. What are the key differences there? Why pick one lane?
It's a big strategic choice. Dividends are usually seen as a commitment. They're regular, predictable payments.
Like getting a check in the mail, sort of.
Pretty much.
Yeah.
They appeal to income investors. And once you start paying a dividend, cutting it sends a really negative signal. Investors hate that.
Okay, so dividends are steady, a promise. Buybacks, then? More flexible. Is that the idea?
That's the main advantage for management, yes. Flexibility. Buybacks are discretionary. A company can announce a big program, but then execute it slowly, speed it up, pause it, depending on market conditions, cash flow, whatever.
So they're not locked in.
Exactly. They can use them opportunistically, like when they think their stock is undervalued, or just when they have a pile of cash and maybe not enough great internal projects to fund at that moment.
And I've heard there can be tax advantages, too, for the investor.
Sometimes, yes. Depending on the jurisdiction, capital gains from selling stock might be taxed differently or later than dividend income, which is usually taxed right away. But again, buybacks don't give you that steady income stream. Different appeal.
Got it. Okay, so with that framework, let's talk successes. Who has used buybacks really strategically, not just as a gimmick, but as part of a smart plan?
Well, you almost have to start with Apple.
Yeah, they come up a lot.
Since 2012, they've spent, it's over $500 billion on buybacks. It's the biggest program ever.
Staggering.
It is. And what's interesting with Apple is how they did it. Massive free cash flow, yes, but also bringing back billions earned overseas, that cash repatriation. It wasn't just about EPS. It was a huge signal of confidence. Management basically saying, we think our stock is the best investment out there right now.
A powerful message. What about other tech giants? Do they follow the same playbook?
Microsoft is another interesting one. They also do significant buybacks, but they pair it with paying consistent dividends.
A balanced approach?
Right. It signals balance.
Uh-huh.
We're investing in growth, in AI, in the cloud, and we're returning capital to shareholders. It shows you don't necessarily have to pick one over the other, even in tech.
So it's not just about boosting the numbers, it's about the story the company tells with its cash. What about, say, Meta? They've had some ups and downs.
Meta's a great example of using buybacks countercyclically almost. When their stock price dipped significantly in 2022, 2023, amid all the metaverse skepticism,
Right, there was a lot of doubt.
they actually increased their buyback program. It was a strong signal from management saying, look, we believe in the long-term value. Even if the market is shaky right now, we think our stock is cheap. While still investing heavily in AI and their core platforms, of course.
Putting their money where their mouth is, essentially. Okay, stepping outside tech. What about a more traditional, maybe cyclical industry, like energy?
ExxonMobil's a good case study there. They tend to ramp up buybacks when oil prices are high and cash is pouring in.
Makes sense.
But crucially, they often pause or scale back those programs when prices fall during downturns. Then they reinstate them when things boom again, like they did post-2021. It shows how buyback strategy has to adapt to the bigger economic cycles, especially in volatile sectors.
And we have to ask about Warren Buffett, Berkshire Hathaway. He's always had a unique take.
Absolutely. Buffett, historically, was very resistant to buybacks unless Berkshire's stock was trading well below what he calculated as its intrinsic value. He's the ultimate value guy.
Only if it's a real bargain.
Exactly. But interestingly, in recent years, Berkshire has significantly increased its buybacks, explicitly stating they felt the shares were undervalued. So it's a pure value play for them. Not about managing EPS quarter to quarter, but about buying their own business when they think it's cheap.
So pulling back a bit, from a CFO's chair, what's the general appeal beyond these specific cases?
Well, we mentioned flexibility. That's huge. They can also use buybacks to sort of smooth out earnings per share, make it look less volatile, which analysts sometimes like.
Okay.
And another big one is offsetting dilution from stock-based compensation. When companies give shares to employees.
Right, stock options and grants.
That increases the total number of shares. Buybacks can counteract that, keeping the existing shareholders' slice of the pie from shrinking.
Got it. Okay. We've heard the good, the strategic.
Yeah.
But now, where does it get, well, really interesting. When do buybacks go wrong? Because like you said, higher ETS doesn't automatically mean a healthier company.
No, it definitely doesn't. And this is the critical part. Buybacks can absolutely mask underlying problems. If a company's core business is struggling, but they keep buying back stock, the EPS might look okay, or even good.
While the actual profits are falling.
Exactly. It can create a false sense of security, or worse, be used intentionally to distract from poor operational performance.
Is there a really stark example of this? A cautionary tale?
Bed Bath & Beyond is probably the poster child for buybacks gone wrong. It's quite tragic, really.
What happened there?
Over several years, they spent something like $11.8 billion buying back their stock.
Billion, with a B.
Billion. Even while their sales were visibly declining. And a big chunk of that, especially a large buyback in 2014, was funded with debt.
Uh-oh.
Yeah. So the stock might have popped temporarily, but the company got saddled with way too much debt, over-leveraged. When things got tough, they hit a liquidity crisis, couldn't pay their bill.
And that led to
bankruptcy in 2023. It's a textbook example of terrible timing, ignoring fundamentals, and using buybacks funded by debt in a way that ultimately destroyed the company.
Wow. That's sobering. I also remember a lot of controversy around another big company during a crisis relating to buybacks.
You might be thinking of Boeing.
Yes, that sounds right.
Between roughly 2013 and 2019, they spent a massive amount, around $43 billion, on share repurchases.
Okay.
Then COVID hit, air travel collapsed. Boeing suddenly faced a huge liquidity crunch. They had to stop the buybacks and, controversially, ended up needing government support.
And the criticism was they should have kept that cash.
Precisely. The criticism was intense. Why spend billions buying back stock instead of keeping a stronger cash buffer or investing more in R&D, especially given the issues they'd had with the 737 MAX? The optics were just terrible.
Yeah, spending billions on buybacks then, asking for help or laying people off, that doesn't sit well. It seems like a really delicate balance.
It is. And you can contrast Boeing maybe with General Motors after their own crisis, the 2008 restructuring.
How did they handle it?
Much more cautiously. They eventually returned to buybacks, but gradually. They avoided really aggressive repurchases, especially during uncertain times. It showed a more disciplined approach, focused on stability after having gone through financial distress.
So, lessons learned, perhaps. And are regulators watching all this? Is anyone stepping in?
Oh, definitely. Regulators are paying attention. In the U.S., a 1% excise tax on stock buybacks was introduced in 2023. Makes them slightly less attractive financially.
A small tax, but a signal.
Exactly.
Yeah.
And the SEC, the regulator, has proposed rules for more transparency. They want companies to disclose more about the timing and the reason for their buybacks. Why now? Why this much?
So investors get a clearer picture.
Right. Plus, you add rising interest rates into the mix. Suddenly, funding buybacks with debt looks a lot riskier and more expensive than it did when rates were near zero.
Okay, that makes sense. So for a company's leadership team trying to make these calls, what does smart capital allocation actually look like in practice? How do they decide if a buyback is the right tool?
It's a constant juggling act, really. Modeling trade-offs. You're always asking, should we pay down debt? Is there a killer R&D project we should fund? Should we start or raise a dividend? Or should we buy back shares?
Lots of competing priorities. Is there maybe a sort of mental checklist? Questions they might ask themselves that maybe our listeners could use too when looking at a company?
Yeah, I think you could boil it down to a few key questions. Something like, first, do we genuinely have excess free cash flow? Cash we don't need for operations or solid investments.
Okay, is it truly spare cash?
Second, are our internal reinvestment opportunities kind of limited right now? Or maybe the expected returns just aren't that high? If they're great projects, they should probably come first.
Makes sense. What else?
Third, and this is crucial, will this buyback really improve long-term value, or is it mostly about juicing this quarter's EPS number? Requires some honesty there.
Right. Looking beyond the short term.
Fourth, how does it impact our balance sheet, our leverage ratios, our credit rating? Are we taking on too much risk, too much debt?
Financial health check.
And maybe finally, are we being transparent with our investors about why we're doing this? Can we clearly explain the rationale?
That's a great checklist. It really drives home that buybacks aren't just a thing you do in isolation. They're one tool in a much bigger financial strategy kit.
Absolutely. Context, timing, underlying business health.
Yeah.
It all matters immensely.
Okay, so let's try to sum this up then.
Sure. So stock buybacks can be really smart. They can be effective tools for allocating capital, returning value, especially if a company's stock is genuinely undervalued or they just don't have better places to put their cash at that moment. But as we saw with Bed Bath & Beyond, maybe Boeing to some extent, when they're done for the wrong reasons, just to hit an EPS target, mask problems, funded with too much debt, timed poorly, they can be incredibly destructive, a huge liability.
So they're not a strategy on their own, they're a tool. And like any tool, it really matters how and importantly why you use it. Understanding that gives you, the listener, an edge, right? Whether you're investing or just watching the markets.
It really does. It makes you look past the headline announcement and ask, why is this company doing this now? Does it align with creating actual sustainable long-term value? Or is it something else?
A much deeper question. So here's something to think about for you, the listener. As we see regulations potentially tightening, interest rates maybe staying higher, economic cycles doing their thing, how will companies balance that immediate satisfaction a buyback can provide with the longer-term needs for innovation, resilience, even things like public perception?
Yeah, that tension isn't going away.
Definitely something to mull over. We'll leave you with that thought until our next deep dive.
Thanks for listening to Corporate Finance Explained. If you found this episode valuable, be sure to check out more episodes and explore CFI's highly rated courses at corporatefinanceinstitute.com. Don't forget to subscribe for more deep dives into essential finance topics. See you next time.